Hi, everyone, and welcome to the Cliffwater Direct Lending Index quarterly webinar for 1Q26. My name is Fran Byers. I'm head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO of Cliffwater and the creator of the CDLI. Cliffwater is an alternative investment advisor founded in 2004 with broad experience across the full spectrum of alternative investments. Today's session will begin with Steve walking through first quarter direct lending performance. I'll then cover the themes shaping the market so far in 2026. And with that, let me turn it over to Steve.
Thanks, Fran, and thanks everybody for joining us today. I'd like to just start with a reminder as to what the middle market is. And with this table, I'd like to focus on the second row, the number of employees, because my point here is to let you know that the middle market is a very critical part of the U.S. economy. And focusing on the second row, really the number of employees. Across the entire private sector in the U.S., there are about 120 million employees. Okay, roughly half of those are employed by publicly traded companies. The other half are represented by private companies. And I divide those private companies into really three groups. The institutional middle market, okay? A subset of the institutional middle market is the private equity sponsored or private equity backed middle market companies, okay? And then we have small companies defined as private companies with less than 50 employees, okay? So publicly traded companies, 60 million employees. The institutional middle market, 40 million, of which 10 million are private equity backed. And the remainder, I guess you could call them mom and pop shops, but they're really much more than that, employing about 20 million employees. So the middle market that we operate in is principally that second to the right-hand column, the sponsor-backed or private equity-backed middle market, employing 10 million within the entire institutional middle market of 40 million. So if you're trying to do the addition here, of the 120 million in the private sector in the US, half are publicly traded and the other half private. The private is comprised of the 40 million plus the 20 million. You can go through these other statistics at your leisure, but basically the point here is middle market lending, represented by the CDLI, is really a very critical part of the entire U.S. economy. Okay. All right. Headline news for the first quarter. Total return for CDLI was muted. It was positive, but muted at 1.12%. It has three components, as I think many of you are aware. Interest income was 2.30% for the quarter. Also a little muted, primarily because, again, the lower SOFR rate and some spread tightening. The second component is good news, realized losses. Realized losses were really pretty minor, 11 basis points for the quarter. You annualize that at 44 basis points, well below the long-term average of about 1%. Kind of the surprise, and which caused the CDLI return to be muted for the quarter, was a significant increase in unrealized losses, minus 1.07%. And again, I'll talk a little bit more about this, but the unrealized losses are really from markdowns of loan prices. They're really not real. These aren't real losses. These are really reserves, if you can think of it that way. It's similar to bank reserves. as possible offsets to future realized losses. Anyway, together, those three components caused a 1.12% return for CDLI for the first quarter. Many of the actual managers may have negative returns, particularly those with higher fees, use of leverage. Those unrealized losses will really pull down their numbers, either close to zero or in some cases even negative. For the trailing year, we're looking at a somewhat muted 8.19% return. Again, those recent quarter unrealized losses impacting the trailing year returns. Again, long-term, far right-hand column from inception, we have achieved and in the future expect to achieve in the index something between a 9 and 10% expected return with yields of 10% or more offset by realized losses of averaging about 1% or actual number of 99 basis points. If we look at the chart below, I show quarterly CDLI returns from inception. Again, the return primarily driven by interest income, interrupted sporadically by low or negative returns, the worst returns during the Great Financial Crisis and during COVID. I added here three arrows on the right-hand side, basically three periods that also reported muted returns. Obviously, the most recent quarter, low over 1%, but also returns during the interest rate hike during 2022, that middle arrow, and the left-hand arrow during the fourth quarter of 2018. That was also a period where the Federal Reserve started increasing significantly interest rates, creating a lot of uncertainty and really causing credit spreads to really widen significantly. My point in drawing attention to these three quarters is observe that in the following quarter or following quarters, returns quickly reverted to their double-digit quarterly levels. So the point is that oftentimes when we get a significant jump in unrealized losses, after there's a gut check or reality check, these unrealized losses are quickly reversed. Don't know if if it'll happen this time, but that's been the historical record. And on this next slide, just want to show that the value proposition for private debt as captured by our CDLI index really remains. And we show the bars here, interest income, rolling 4 quarter, and then we show realized losses over the trailing 4 quarters. Except for fees and leverage, this reflects the economics that really matter. As I said before, unrealized losses really don't matter over time. And if we look at the differential at the end of March, subtracting the 58 basis point 4-quarter realized loss from the 4-quarter interest income of 10.12%, that equals 9.54%. So that is basically the return an investor is taking home gross of fees and leverage. That is close to, but just a little bit below the historical average of 9.89%. So roughly 30 to 40 basis below the long-term average. Again, my point being the investment thesis for private debt continues to stand. Now, let me turn again back up to unrealized losses. And as I was saying before, unrealized losses are really like a loan loss reserve, where valuation firms anticipate losses and they'll mark down the portfolio or the loan portfolio to reflect what they expect future losses to be. So the green bars show unrealized losses and unrealized gains over the life of this CDLI. My observation first is that these unrealized losses really tend to be overstated. There's a lot of talk about valuation, private debt valuation. If you look at the history, the valuation, at least to the extent it anticipates future realized losses, is actually pretty conservative. So for example, starting on the left, during the financial crisis, unrealized losses were 16. They ended up being, realized losses ended up being 9%, if you look at the red line. In the middle part of the chart, during the Euro crisis and threats on downgrade of the U.S. Treasury, unrealized losses of about 5%. Actually, they came in 2%. And then during COVID, -7 came in at about -3, and then during the recent interest rate hike in 22, again 2+%, but they actually came in at about 1%. So again, if you believe valuation within the private markets should reflect expected loss rates, realized losses, the independent valuation firms do a very good job, and if anything, they end up being conservative. So what about today? So if you look at the far right hand side, I'm showing two numbers in blue. Right now we're running at 58 basis point loss rate for unrealized losses, okay? Excuse me, for realized losses, of low level of realized losses. But all of a sudden in the quarter, unrealized losses have jumped to -1.22%. This, if history is a lesson, what it tells us is, gee, that 122 basis points probably overestimated by half, so call that 60 basis points. That's generally impacts over the following 3 years. So let's call it 20 basis point per year. So if we're running at 50, keep the math simple. If we're running at 58 basis points, let's call that 60 basis points. Add 2% over the next 3 years. That means we're running at about 80 basis points, or just below the long-term average of 1% per year. So the market is smart, okay? And so what it's telling us is realized losses are likely to drift upward, okay? But to a level probably more reflective of the long-term historical average. The market's not telling us, oh, gee, we're going to have realized losses of 2 or 3%. Okay, so what is the source of these unrealized losses? So we broke down the I think it was 1.2% in unrealized losses for the quarter. And all the talk is about software. So what happened in terms of software? So the first point, software unrealized losses, markdowns equaled 3% in the first quarter. So overall market, a little over 1%, 3% though in software. Not every manager, not every portfolio was marked down 3%. My second point here, there was a significant dispersion in markdowns across managers. There's a lot of thinking going into, hey, what software is really at risk from AI and what software is not at risk from AI. Basically two buckets here. Horizontal bucket, okay, cutting across really all sectors, really facing consumer. And then enterprise critical software, which they call vertical software. Vertical software is less susceptible to AI disruption, unlike horizontal software. So if you look at underlying portfolios of individual managers, it can really vary on what type of software they have exposure to. Anyway, if you look at this chart at the bottom here, I show the distribution of software markdowns by BDC manager. Not all, it contains about, I forgot, 45 to 50 BDC managers. Not all managers have a software, have a designated software industry group. So I've only looked at those that did, which represent about 75% of the total by assets. But basically you can see managers mark their portfolios down, their software portfolios down between 1% and 5%, with the average being about 3%. Software represents about 20% of total assets at cost value. So you take that 20% times the 3%, you get roughly 60 basis points, really representing half of the 1.12% unrealized losses for the quarter. So we wanted to give you this additional information, and over the subsequent quarters, we'll see. We'll look at where marks drift going forward, whether it's up or down, and what realized losses actually come out of this current cycle. I'd like to finish up with a couple of charts that I showed you last quarter. The first is the long-term performance by yield for different credit: public credit, high yield bonds in the first column, leverage loans in the second column, middle market debt, that's the CDLI. And my point is that high yield bonds have the greatest loss. A lot of these are second lien or subordinated debt. Their loss rate is on average higher, whether you look at 21 years or 10 years. Leverage loans and middle market debt, private middle market debt, run about the same. Over the 21-year period, it's at about 1%. Let's call it a toss-up. More recently, it's been, over the last 10 years, a little higher for middle market debt. But if you broke it down into 5-year periods, over the most recent 5-year period, middle market debt has performed much better in terms of lower losses versus leveraged loans. During COVID and for a few years prior to that, leveraged loans had the advantage. But basically, when I think about risk of loss as opposed to market risk, basically about the same between leveraged loans and middle market debt. And then I'd like to finish with, again, a repeat from last quarter. So here I'm looking at total return. Obviously, realized losses are a part of this. And I'd like to focus on the first column, the Cliffwater Direct Lending Index, CDLI, and the third column, which is its closest benchmark, the Morningstar LSTA US Leveraged Loan Index. So let's look at the last 21 years. 9.53 versus 5.07. So that's like a 4.5 differential, okay? Over the last 10 years, it looks to be a little less than 4, 3.5. I can't do the math in my head, about 3.5. And over the last 5 years, it looks to be about 5%. Now, and let's look at 2025. In 2025, that differential is about 3.5 3.5%. My point here, my point here is simply this. There's all of a sudden I'm hearing at conferences speakers say, "Hey, the private debt beta trade is dead, no more." I don't know what data they're looking at, but our data shows that that's far from the truth. And even if you look at the first quarter of this year, the CDLI, even though it was muted at 1+%, the leverage loan index was negative, close to 1%. So even just for the quarter, private debt has a 1.5+% advantage on broadly syndicated loans. So I don't know what some of these people are thinking. Maybe they want you to focus on alpha or go back to publicly traded debt. But the numbers continue to favor private debt if you want exposure to credit and are willing to give up some level of liquidity. So with that, I'll finish and toss it to you, Fran.
Thank you, Steve. When markets trade at historically tight levels and competition remains elevated for an extended period, a period of volatility and repricing is almost inevitable. And that dynamic played out in the first quarter of 2026. We had a combination of negative media attention, elevated redemptions from the wealth channels, slowing inflows, concerns around AI-driven disruption, and pockets of economic softness tied to both inflation and policy shifts, has all led to a broad recalibration of risk across the direct lending landscape. Flipping to the next slide, we can elaborate on a few points that Steve noted earlier regarding unrealized losses, particularly in software. These markdowns were the primary driver of this shift that we saw in CDLI performance this past quarter. Valuation providers and lenders reassess portfolios with a much sharper focus on AI disruption risk, segmenting borrowers into low, medium, and high exposure. That distinction drove meaningful dispersion and enterprise valuations across both public and private markets. Most technology positions experienced markdowns ranging anywhere from 100 basis points to 400 basis points during the quarter. And in liquid markets, software loans traded down into the low 90s, compared to the broader loan market in the high 90s. As shown here on the chart on the right, price declines, particularly in software, accounted for the majority of negative returns within the Morningstar LSTA index, with the subsector contributing a significant drag. With technology being the largest industry represented within CDLI at 23% of portfolios, it's not surprising that the majority of the negative 1.07% quarterly unrealized move was concentrated there. Managers with heavier tech exposure, those with more than 20% allocation within their portfolios to software, saw average unrealized losses of about 124 basis points within their overall portfolios. Similarly, upper middle market strategies, which tend to have greater technology exposure, experienced markdowns in line with these levels, while lower middle market portfolios were far less impacted at only 35 basis points of unrealized loss. Importantly, this is not indicative of a broad credit downturn. Underlying fundamentals remain solid, with most managers reporting healthy revenue and EBITDA growth. The pressure we saw was largely valuation-driven, not necessarily credit-driven. Since quarter end, sentiment in the loan market has begun to stabilize. The market is becoming more discerning and assessing AI risk for sure, and many core software segments, particularly vertical ERP systems, continue to perform pretty well. While loan prices in the syndicated loan market have partially recovered, we can see here that technology does still lag other sectors, suggesting that AI will remain a central theme in the quarters ahead. Moving to the next slide, we can address another key theme that we saw in the quarter, which is flows and investor behavior within direct lending. Redemptions in retail and high net worth channels reached an all-time high of just over 5%, while net inflows slowed significantly, falling to 1.7 billion, well below prior quarters. Despite this, institutional investors remain steady and are staying the course within direct lending. We've seen a myriad of announcements that have come out as of late around direct lending about managers raising large dollars for their private funds and other strategies within private credit. Meanwhile, realized losses for non-traded BDCs within our CDLI sub-index continues to be extremely low, just 5 basis points in the quarter and 36 basis points over the trailing year, well below long-term averages. In addition, unsecured debt markets remain highly receptive to these perpetual vehicles, with strong demand and oversubscription for new issuance for many perpetually private BDCs in recent weeks. That said, investors are becoming more selective. Performance dispersion is apparent, and it's driving a reassessment of manager allocations across the landscape, with capital increasingly concentrated among top performing platforms. Looking ahead, redemptions are expected to remain elevated in the near term, particularly given the recent varied performance across the landscape and the continued media scrutiny. Moving to the next slide, we can turn our focus to deal activity. Now, direct lending volumes did decline meaningfully so far this year. They're down roughly 30% from the levels we saw in 4Q25, and they're down 24% year over year. That said, issuance still approached 80 billion in the first quarter of 2026 within direct lending, with new money lending driving the bulk of activity. This highlights the continued importance of the direct lending asset class. Market conditions in April did remain a little bit soft, though early signs in May are suggesting a gradual recovery in activity. Technology lending has seen the most disruption clearly. Many lenders have become more selective or stepped back entirely from software lending, while others are leaning in as they're seeing more attractive terms, higher spreads, lower leverage, and stronger documentation. At the same time, a lack of transaction volume across the market has left the market in a period of price discovery, particularly for software enterprise valuations and spreads. Outside of tech, lender demand remains very strong, which is limiting broader spread expansion. First lien spreads have modestly widened into the 510 basis point range as of late, which is a nice 25 to 50 basis point improvement from the 450 to 475 spreads we were seeing in 2025. But the spread widening is far from the dislocation highs that we saw in 2023. Public syndicated loan markets are also showing a similar pattern, with spreads tightening again, a theme due to the limited supply in the market, as evidenced by the B-rated and double B-rated spread chart here in the right-hand side of the slide. Moving to the next slide, we are also seeing a clear divergence between upper middle market and lower middle market lending. Much of the recent growth in AUM, particularly from wealth channels, had been concentrated in larger managers and larger deals. That growth has now stalled, as you can see in the AUM chart here on the left-hand side, when we look at Cliffwater's upper middle market sub-index. In contrast, lower middle market strategies have remained relatively stable, supported by longer duration institutional capital and less exposure to retail flows. Notably, the upper market is where we are seeing the most meaningful improvement in pricing, with spreads moving higher, while the lower market has seen less change and remains highly competitive. Given this dynamic, we could see increased competition from the syndicated market trying to win back some larger borrowers via repricings in the near term. Moving to the next slide, I want to talk a little bit about risk-adjusted return, because a key question that we're getting from high net worth investors is whether private credit is still offering attractive risk-adjusted returns in light of the background. And the answer is most certainly yes. Loan-to-value ratios, shown here in the chart on the left, tell a very important story. They peaked during the low-rate environment of 2021 to 2022, when leverage and valuations were elevated. Since then, underwriting has become far more disciplined, and LTVs have improved across sectors, reaching very attractive levels in 2026 across most industries. So we have sponsors are still paying hefty multiples for borrowers, even today, but leverage has improved through time. This also helps explain why many credit issues that we're seeing today are tied to earlier vintages. Most recent loans originated in a higher rate environment were structured more conservatively. At the same time, yields do remain compelling, with portfolios generating returns in the 9 to 10% range above long-term averages. Now, while we have seen and heard about a lot of dividend cuts and pressures from BDCs in the headlines, this is being reflected due to spread and base rate compression. Current conditions suggest that there is greater stability ahead, supported by base rates that are likely to stay higher for longer due to inflation and slightly wider spreads relative to last year. Now, moving to the next slide, we can turn our focus to credit quality. The overall picture remains relatively steady, with a few areas to watch. Starting with the positive side, realized losses remain very low and well below the long-term average. Meanwhile, PIK income as a percentage of investment income has showed a continued decline over the past few quarters, reflecting improved borrower affordability. However, watchlist loans and non-accruals both moved modestly higher this past quarter. Importantly, this was driven more by size of borrowers defaulting, not by a higher count of borrowers defaulting. So we saw a handful of larger deals default within the index this past quarter. We're not necessarily seeing a broad deterioration across the index. Furthermore, we did see the share of loans marked below 90, which is our barometer of stress, tick up modestly to around 6.5% of the index from 6.1% last quarter. Now, mark-to-market changes in software could be a factor to the increase in this metric, but also we did see a handful of amended PIK loans get marked down into the high 80s this quarter on average. So this is a combination of valuation pressures on tech, coupled with further markdowns on some existing underperforming names. If we dig into some of the sector trends that we're seeing, they are very mixed, with some sectors continuing to perform very well, like services, financial services, aerospace and defense, and there's some sectors that are seeing softness. Consumer and auto comes to mind. These are sectors that continue to face tariff-related pressures and rising input costs. Now, while there have been a lot of announcements of tariff refunds, which could help alleviate these pressures near term, inflation is now yet again back on the rise. This time it's driven by escalating energy prices stemming from the Iran war. Those inflation pressures could mute some of the benefit of getting tariff refunds for some of these good-sensitive borrowers. Manufacturing is performing unevenly. It really depends on end market exposure. Some industrial companies continue to perform very solidly if they're exposed to more defensive and steady end markets, while others are seeing general slowdowns if their end markets are more cyclical, tied to consumer spending, such as construction or personal care products, or chemicals or distributors. Technology remains fundamentally sound despite the valuation volatility and the AI disruption fears. Issues in tech names continue to stem from over-levered capital structures, coupled with the bank group and the sponsor underestimating the strength of the competitive landscape. So we see often very large incumbent tech companies will sometimes undercut smaller middle market companies on price. Those tend to be the issues. We're not hearing about AI disruption necessarily causing issues in tech names, not yet. Healthcare, particularly physician practice management, continues to face some structural challenges, including doctor turnover, wage and labor pressure. Furthermore, de novo growth and buy and build strategies have really come under pressure in a higher rate environment. But outside of physician practice management businesses or some of the few dental service organization defaults that we've seen, the healthcare space is actually performing really well. Notably, several of the largest defaults this quarter were tied to 2021 and 2022 origination vintages, reinforcing the importance of vintage risk. And you'll see some survey data that we have here on the bottom of the slide, which further supports the view that the broader market remains relatively healthy and steady, with lenders citing that the majority of loans are performing in line or above lender underwriting expectations. Now, while lenders do estimate that roughly 16% of their book is tracking below plan or below budget in this survey, this is actually an improvement compared to the 25% of lenders that cited this several quarters ago when base rates were more elevated. Now, moving to the next slide, we can dig into upper middle market versus lower middle market in more depth. While the saying goes that bigger is better, it does not mean that larger deals are immune to stress. Non-accruals increased more noticeably at the upper end of the market in 1Q26, driven by 2 to 3 large defaults. Meanwhile, lower middle market portfolios have remained pretty stable, with lower loss rates and less volatility in recent quarters. Now, lower middle market strategies tend to exhibit more dispersion over time because these lenders tend to have more concentrated portfolios at that end of the market. Lower middle market also benefits from structural protections, such as tighter documentation, and many of these portfolios have equity tags to mute some of the losses that we can see on smaller borrowers. The timing of those equity tags hitting can be episodic. They're highly tied to M&A environments, hence the more volatile realized loss and non-accrual performance metrics you're seeing here on the slide relative to the upper middle market through time. Now, moving to our final slide, we can look at a broad measure of portfolio stress within the CDLI by combining non-accruals with amended PIK loans. This is a new analysis that we started doing just this quarter. This really helps capture a more comprehensive view of stress and credit pressure beyond just a traditional default or non-accrual metric. At the end of 2025, this measure showed that borrower stress was at around 3.5% of the index. It has increased in 1Q26 to just over 4%, reflecting some incremental pressure, though still within a manageable range by historical standards. This jump was driven more so by the default rate, which rose to 2.1% from 1.6% last quarter. Meanwhile, new loans moving to amended PIK actually stayed steady. It was 2% last quarter, and it remained at 2% this quarter. So not a lot of new big loans being amended to PIK. Interestingly, the 2 to 3 large loans that defaulted in 1Q26, bringing the default rate up, were actually reflected in our amended PIK metrics between 3Q24 and 2Q25, bringing that amended PIK rate to a more elevated 2.5% to 3% at the time. So the amended PIK metrics are a good indicator of future defaults, roughly 2 to 4 quarters before a loan is placed on non-accrual status. The overall takeaway remains consistent. Yes, stress has risen modestly, but it's still well within the historical norms of the index. And the increase in stress was more concentrated this quarter in a few names rather than systematic. That concludes our prepared remarks. Thank you all so much for your time and support. Wishing everyone a wonderful summer.